What if I tell you that a smartly invested 5,000 rupee portfolio investment can grow to a mammoth 2 billion rupees worth in value? Now, like several other people, you won't believe it too, but it has been done repeatedly by many of the most successful investors in India, like Rakesh Jhunjhunwala, Dolly Khanna, Vijay Kedia, and others. Before diving into the smart investor strategies that can help you beat the market, we would request you to like and subscribe to our channel. This will enable more future investors like you to watch this video and use these strategies to take advantage of the market and create gigantic fortunes from it. We have also added a bonus for our viewers who stay with us till the end of this video. For an above-average investor of the Indian stock market, investing in Sensex would have brought only 36 to 40 times returns. But how do these top investors, also labeled as oracles of Omaha of India, manipulate the Sensex to bring a whopping 4,000 times returns? Sensex, a portmanteau of two terms, sensitive and index, denotes the most popular market index of 30 companies listed under the Bombay Stock Exchange. This isn't something unthinkable. It is a combination of the right strategies along with truckloads of patience. Here are the 5 highly effective yet smart strategies that we as future investors should abide by. But first, let's get clear on what PE and high dividend yields mean. PE, the price to earnings ratio or PE ratio, measures the relationship between a company's share price and its earnings per share. The ratio is employed to evaluate businesses and determine if they are over or undervalued. A stock's PE is calculated by dividing its price by the per share annual earnings of the company. A stock has a PE of 20 if its share price is $20 and its earnings per share is $1. As for high dividend yield, a corporation with a high dividend yield means that it is distributing a significant amount of its earnings to its shareholders. By dividing the annual dividend per share by the stock's current price, you determine the dividend yield. The dividend yield, for instance, would be 2% if a corporation paid a $1 annual dividend per share and its stock price was $50 at the time. Now, how do you identify companies with high dividend yields? We've got you covered. Examples of companies with high dividend yields are real estate investment trusts or REITs, utility companies, and some blue-chip companies. Steady business models, along with stable, consistent earnings, enable these companies to pay out a significant portion of their earnings as dividends. Now coming back to our 5 smart investor strategies that can make you from having nothing to creating a well-balanced portfolio for yourself. Style of investments. Style of investments means choosing stocks based on the nature or company of the stock. There are 2 styles of investments that we'll be talking about today. The first is value stock style. These refer to stocks that are presently undervalued in the market. The current market prices of these stocks are much lower than their individual numbers. They usually have low PE ratios along with high dividend yields. The second is growth stock style. Growth stocks are expected to grow faster than their counterparts. One distinct characteristic of these kind of stocks is that they don't pay dividends. Instead, the money is reinvested into the company for growth. These stocks are relatively riskier than value stocks as there's no dividend involved. Following is a comparison of Dolly Khanna and Rakesh Jhunjhunwala's portfolios. Dolly Khanna usually follows the growth style of investment. Whenever a stock enters Dolly Khanna's portfolio, it is almost automatically assumed that it will be a multi-bagger. The investment philosophy of Dolly Khanna and her husband Rajiv Khanna, who is the man behind all the stock picking, is acquiring growth firms in the small and mid-cap sectors. They hold the stocks for a long time and let the business grow, which then converts the stocks to the multi-baggers category. Rakesh Jhunjhunwala strongly follows the value style of investment. He starts by carefully examining the company's expansion and financial strategy. The company won't be accepted into Jhunjhunwala's portfolio if the techniques are too complicated. A compelling growth story and the company's potential are the primary selection criteria to enter into the portfolio of India's Warren Buffett. Jhunjhunwala and Warren Buffett have essentially identical investment philosophies, which include holding on tight and consistently seizing opportunities. One of the philosophical contrasts between the two is that Jhunjhunwala favors financial leverage or borrowing money to make investments, whereas Buffett does not. Portfolio diversification is based on the principle of not putting all your eggs in one basket. This enables you to control risk and balance off volatility. If you have a diverse portfolio, the other investments will grow even if one investment declines. Most smart investors reduce risks by investing in multiple types of assets. This way, not only do they spread their portfolio, but they get hefty amounts in returns as well. Rakesh Jhunjhunwala, also known as India's Warren Buffett, has a staggering portfolio net worth of 32,000 crore rupees. Also known as the Big Bull, he started with only a 5,000 rupee investment and soon found success in this world. His 31,883 crore rupees portfolio is diversified across 23 sectors, including stocks from sectors like banks, pharmaceuticals, etc. to less popular sectors like agrochemicals, edible oils, etc. Long-term investing is a strategy where investors hold on to their investments for a longer period of time, usually 5 years or more. A long-term investor does not care about short-term gains. They have eyes on the bigger goal. It is important to do your research, be realistic, and sell losing stocks to minimize further losses. Peter Lynch, an American investor and mutual fund manager known for his razor-sharp stock-picking skills, has made a fortune by utilizing some selective stocks in his portfolio. He has introduced the terms multi-baggers and 10-baggers. Multi-baggers refer to shares that provide returns that are multiple terms of the amount invested, whereas the latter term refers to the shares that provide returns that are 10 times the amount invested. The only way of getting multi-bagger returns is by controlling the urge of selling stocks when they're at an all-time high, because even after this rise, there might be chances of more growth. As an investor with bigger goals in mind, you need to let go of hot tips and general perceptions. The only way to judge a company is by its fundamentals and merits. A risk appetite is an individual's ability to take a risk with their finances in hopes of making higher profits through these investments. It is nearly impossible to get some monetary gains without taking risks. This last tip that we're about to share with you is what has enabled Warren Buffett to build a gigantic fortune for himself, and no, it's not patience. Certain investors like to go against the herd and the general market sentiment. They're called contrarian investors. This style of investing is called contrarian investing. These investors intentionally take positions that are opposite to the herd. They go against the general market trend and investor sentiment. A contrarian investor buys a stock when others are selling and sells stocks when others are buying. The main idea behind contrarian investing is that the markets often go through a wave of behavior that is triggered by investors' greed and fear. Following the market sentiment is like doing suicide for a contrarian investor, because for them, following a herd mentality can lead them to suffer losses, which is why they go against the market in their trades. In contrarian investing, contrarian investors believe that when other investors are fully invested in the market and have no more purchasing power left, the market is at its highest bull peak. From this point onwards, the market can go only down. Due to the apparent market sentiment, other investors may start investing. Contrarian investors, on the contrary, will start selling. This will help them to reduce losses in case the market goes down. Conversely, if the majority of investors are advocating a decline in the market, it indicates that they have already sold off practically all of their holdings. This in the contrarian investing dictionary means that the market will go up, which is why they start to buy more stocks, resulting in higher profits if the market goes up. The best way contrarian investors identify a potential contrarian opportunity is by analyzing the general market trend and investor sentiments. For instance, if there's continuous news about the increase in a particular stock or rise in the market, this can be a starting point for you to put on your contrarian investing hat. Eventually, every stock goes to its true value, whether up or down. Let's say stock A is in the news, making it a hot stock. A contrarian investor will monitor the stock continuously along with performing detailed analysis to understand its true value. Since there's a probability that investors may overreact, there will be a sudden rise in the prices of these stocks. Once the stock has reached its peak, the contrarian investor will wait for it to fall and then enter the market by buying these stocks at a low price. When the stock returns to its original value, the investor who studied the market will win and make loads of profits. Whenever you're thinking of investing in the stock market, do refer to this quote from Warren Buffett, one of the most successful investors of the 20th century. I will tell you how to become rich. Close the doors, be fearful when others are greedy, be greedy when others are fearful. As promised, here's the bonus strategy that could help you get ahead of other investors. Dollar cost averaging. This strategy involves investing a fixed amount of money at regular intervals regardless of the price of investment. For investors who are risk-averse or who wish to establish a long-term investment portfolio, this can help to reduce the impact of market volatility on their portfolio. So this sums up our 5 smart investor strategies that can help you beat the market. I would like to end this video with a quote from Benjamin Franklin: "An investment in knowledge pays the best interest." As students of the Indian stock market, what do you think is one thing that is common in all investors? Let us know in the comments below. If you truly want to make your investments bulletproof, watch this video to learn from some of the greatest investors in the history of investing.